Now, Paul, give me some clarity on this, because the way that the questions fall in, I can't always look at it while I'm answering a question. You said, so it would be better to use call spreads. My assumption is that this was during our discussion of iron condors. Compared to the long calls. No. I can't say that, Paul. All right, so back to our long call discussion. We were talking about the risks here of doing the long call, and where I don't want to take necessarily a 50% loss, or I want to set a stop at 33 to 50%. I don't want to take a 50% loss, but I don't want to get closed out too early. And Paul said, well, is it better long-term to use call spreads, to sell a call up here, or maybe do a calendar spread as opposed to the long call? And my answer, in a sense, is no. Meaning that I don't think it's better to do call spreads, debit call spreads or calendar call spreads on the stocks I'm looking for that match my long call goals. See, when I enter a long call, it's because I'm expecting large growth and I don't want to cap the upside, even though it gives me a better, how do I want to say this, a better chance for return. A spread will give you a better chance for return than just a straight long call or long put. That I will say yes to, Paul. Just an experience and just based on the structure of the trade. You can structure it to have a better probability of success continuously to allow this to profit in the direction you want, compound almost, whereas the long call, you're hoping for 150% gain to counter a 50% loss that happened over here and still get a reasonable profit. That I can agree with. But if I've decided, Paul, that I found a stock that I do feel has the potential to really ramp up 10 to 15% in the next 20 to 40 days, I don't want to do it as a spread. I want to do it something that gives me that oomph, that puts me in the structure that gives me that oomph rather than capping the upside. But that being said, Paul, I will say that the portion of my portfolio that's dedicated to bull put spreads, and you could say parities bull call spreads in that case as well, is a larger allocation than what I do for long calls. Long calls, I typically, if I'm doing a straddle for earnings, if I'm buying calls and puts on stock I like, I keep that whole allocation less than 5% of my total portfolio value because I see them sort of as lottery tickets. And I might have 2 or 3 open at a time. I can do all of the due diligence, Paul, and you know this as well. I can do all the due diligence I want and say, yes, this is the stock I really feel comfortable out of all the ones in my list. It's going to move up 10 to 15% in 20 days, and I might experience that 150 to 200% return on this long call. I'm never going to say the market's out to get me, and I'll use those other cliches, knock on wood. What do you think is going to happen when I do that? The 2 or 3 other trades I didn't take are the ones that are going to move up 8 to 10%, and my stock's going to move up 3%. It's just the nature of the game and where it goes. So consistently, with criteria that I feel comfortable with, the bull put credit spread, bull call debit spread structure, even calendar spread structure, looking for stocks that have a better chance of staying the same or just moving up 3 to 4% in the first 12, 15, 20 days or so, I have much greater success than that than consistently picking stocks that move up 8, 10 to 12% over 20 to 40 day period. So, is it better to trade a spread? And then here's how I can answer that. Let's say I was at the good success rate I wanted with those stocks I'm talking about for the long call. Let's say that even 56%, 57% of the time I was right on the stocks I picked that moved up 8 to 10% in that first 20 days. I'm going to be very profitable with that with long calls. Doesn't sound like you would be, assuming I'm not taking 100% losses on the other ones, and maybe I'm only taking a 10, 15% loss, or I only moved up 2 to 3%. But let's say 56% of the time, stocks are moving up 10%. I'm going to be very successful. I can't say that that same win ratio, 56% of the time the stock moves up 10%, another 20% of the time of the ones I select, the stock moves up 3%, 10% of the time the stock falls, so it would be at 86%, 4%, and 5% of the time the stock fell 12%. I'm just throwing numbers out there. I don't have anything to back up statistically that this is my trading record by any stretch of the imagination. So 56 out of 100 times we make 10% on our stocks, which could equate to 150, 200%, well, 150, 160% return on our long calls. 20% of the time it goes up 3%. That might be 20 to 40 to 50% gains on our calls. 10% it goes down, the stock goes down 4%. 10 out of 100 times, that would probably be a 25, 30% loss. And then, you know, the other remaining amounts, it drops down 12 or 15. That'd be close to an 80, 90% loss. This is still successful. If I did this with spreads, where 56% of the time I'm still only making 12 to 15%, 20% of the time I'm making 12 to 50%, 10% of the time I'm losing, let's say, 30% on the spread, and then the other remaining few times, 4, 5, 8%, I'm losing 100% on the spreads. I don't think this would be successful at a 76% win ratio. It needs to be up to 82, 83%. So that's the trade-off. That, I think, is the trade-off. My numbers have shown that with the structure that you look for, if you're looking for a probability on your spreads, a probability success rate of 75%, you need to be right closer to 76, 77% of time to profit long term. If I look for a profit 80% probability, I likely need to be right 82 to 83% of the time. But if I look for to be right 85% of the time, I only need to be right 83% of the time with the structure to profit long term. That's what I've seen. So looking for if this was the breakdown of your success rate with long calls, 56% of the time you find stocks move 10%, 20, the stocks move up 3%, 10% of the time they drop 4%, and the remaining, what did I say, 12% of the time, I'm sorry, 12 or 14% of the time, they drop down further, say 10%. I don't know if you'll be successful with spreads. I honestly don't. We're going to maybe have to take a break and look at some of these. Before I do something else real quick here, we're going to go over the Trade Simulator tool in a moment, and I'm going to rationalize some of these numbers that we just projected to you. We were talking about the 76% probability success rate on spreads, and we're talking about the long call there, limit ratios, and stops for Ronald. Okay, so I'm going to take a look at that tool to show that. But first off, okay, and we can just go to the Resources tab and click on the Trade Simulator. All right, so we were talking about the stops on a long call. And we were saying that we were trying to trigger the 40-50% range. Okay, well, let's say that I used a 25% stop. My loss limit, I'm going to try to limit on my long calls to 25%. Well, actually, I'm taking a 25% loss. I'm only making a return of 10%. I'm going to go bankrupt very quickly. So let's change that. And you're hoping to make 100, 150% on your long calls, but let's say your average is 85. But you know, because your stop is so tight, that you're probably still going to be closing out losers 40%. 40% of the time, you're probably going to hit this target rate. So your probability of loss drops down to 40%. Let's say you take $10,000, you add 10%. You add $1,000 to long calls. With the right win ratio, you can be, as you can see, extraordinarily successful. But if you have a string of losers in a row, or if you're not making the 85%, and you're actually closer to 50%, in this case, it cuts down by a factor of 10. You're still profiting in this situation, okay? But you need to get your average wins at 65. My experience has been that in a long call portfolio, yes, you can see 200, 250, 300% winners, okay? And yes, you can try to limit your losses, but when you limit your losses here, you're actually probably only right 55% of the time. I'm sorry, you're actually wrong 55% of the time because you're closing most of these out for losers before they allowed to win. Now, you're still winning even with strings of losers in a row in this case because of proper allocation. Now, if you change the allocation with the same record, oh, there's good win ratios and everything. Okay. As long as you don't take too many losses in a row, you're doing well. So this is where the trick becomes. Even though this looks successful, it's not realistic long term. So what if we take this to the probability of loss actually to 45%? We keep our 65 and we increase it actually to 85 because we're able to stay in long calls longer without hitting the close, but we are allowing it to take a 30, let's call it 35, maybe 40. Let's call it 40. 40% loss when we're wrong. Okay, so wrong more often than right might still be successful as long as you don't trigger too many losses. You see big numbers here with the right ratios. So it is doable, but only if this happens. Only if you can still make the higher range. A lot of investors I've talked to tell me their average win on long calls is 50. The average loss is 40. That's not bad. That can still be profitable, but you need a winning ratio. Okay, you need to make sure that you have a winning ratio, not the losing ratio. That's tough. Bankrupt. You know, this assumes no other management. There would be other management. That's the trick. But as we saw when, you know, what I was talking about with the married put relation, if I'm right, you know, if I'm right even 5.5 and I control my losses to 5.5 and I'm right only 55% of the time, we're not going to see the same win ratio we saw, but we're going to see positive numbers without ever taking the large dips, which you see with the credit spreads, which is my lead into what I was talking about with Paul, that if I set a 15% win ratio, 15% target for my wins, and 48.1%, nope, not 48. I set a stop of my average loss when I lose is 48%, and I target an 85% win ratio. I'm only going to allocate 33% there. So I can see the 40% return over a course of 1 year, 100 trades I expect with much wilder swings. But I can set the probability to be right, which I can't do in a long call. I'm still taking a chance that I'm going to be right, and I need the average, as you saw, to be 65, 70% return on the winning long calls and not taking the loss higher than 40%. With the out-of-the-money bull puts or in-the-money bull calls, I can set the target range I want for success rate, 85% win ratios. But it gets tricky. Let me show you what I mean by tricky. 84% still good. I know it's random each time, and I apologize for that. 82%, okay. Now we're winning, but we might not be hitting the targets. The reason why we got into bull put spreads, what I was going to show you is that if you're right 80% of the time with expecting 85% winners, you're closer to break even. So what happens if I drop this down to, instead of looking for probabilities of 85% winners on 2 week out, 1 week out bull put spreads with an average return of 15%, what if I take it to 75% probability and up my return to 25%? Okay, now we're still looking pretty good, but what's interesting is if you control the losses more to 50% loss because you're closer to at the money, you find that you're not averaging 25, you're averaging around 22. This is through the testing I did. Now, see, I want to be right 75% of the time, but if I'm right 70% of the time, I'm losing significantly. You know, you have to be right almost 73, 72% of the time to profit long term. And that's okay, because looking for that other probability I mentioned, I still have to be right 80% of the time, and that's the nature of the spread trades. You can look for a much higher return with a lower probability. But if you're not as right as you expected, you're actually significant. And look at the swings here. This is what happens also when you look for higher return in that 75% probability range of vertical spreads. 63% decline on the portfolio, depending on the average wins and losses. 37%. 50% to end up with a winning track record. But when you look for the better probability and you achieve that better probability, even though you're short in your return levels, oh, there's a disastrous one, 77. 85, let's get to 80. 82. Okay, so that's good. 90 is, of course, going to be really good. 86, trying to get lower here. Well, let's keep these same numbers and go to 20. I'm sorry, last one. Let's try to get this down to 80. Yeah, see, now there's, if I'm right only 80% of the time, I have that 40% drawdown to make about a 50% profit. That's the nature of spread trades. So that should only be a portion of your portfolio, but that's just kind of to illustrate there what's going on in this scenario. Okay. There we go. Oh, Sam was talking about the bond market and the gold market before 9 a.m., of course, for international, for global there and what's going on. All right, well, ladies and gentlemen, we are at 6 p.m. Eastern Time. I did not see any other questions come in that I did not get to. Sam did have a comment on some of the other things he was doing there in relation to IWM, QQQ, looking at the certain positions. But I just want to remind everyone that today's material are my thoughts and your questions, designed for educational purposes, increasing investing knowledge, and performance as well. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options involve risk and may not be suitable for all investors. Earlier we talked about the 14-day free trial and the 4 steps. I just want to remind everyone, if you haven't done so already, you can go ahead and go to poweropt.com, and you can go ahead and just put in your name and email address, and you can get access to a 14-day free trial with no credit card required. After the trial, the subscription levels to Power Options start at $45 per month for the end-of-day service, and we have services ranging through 20 minutes and the 20-minute delayed, and real-time also as well. If you want to take out other free education on our extended weekend here, remember you can take the time yourself in the extended weekend. Check out blog.poweropt.com. The webinars page there, poweropt.com/webinars.asp, for the different strategy and options concepts presentations. You can always check us out on YouTube as well. All right, and if you do think of any questions later on, remember you can send me an email at any time to support@poweropt.com or support@radioactivetrading.com. You can also reach us during market hours at 302-992-7971. Reminder again, markets will be closed on Monday, and we will not be available by phone on Monday as well. And of course, remember, trial members and subscribers, you can schedule a coaching session at any time. Again, that's a 35 to 45-minute phone conversation with myself or Ernie. We'll walk you through the tools on the site and answer any questions that you have. All right, so Tom said, thank you, Mike. Ben says, thank you and have a fantastic weekend. Thank you, Ben. You have a great weekend as well. Sam says, thank you and have an enjoyable long weekend. Sam, I hope you have a wonderful weekend as well. And thank you for sharing your comments with us on your recent trades last week, of course, the Contra ETFs and more. And to all of you, have a fantastic weekend as well. And thank you for your questions. Also, I'm going to try to get this webinar converted, posted, archived, and ready for everyone, available on Saturday before we technically go over into September. But if not, it'll probably be available for you Sunday. So you'll have time to watch it over the weekend as well. Tom, you have a great weekend. Also, everyone, thank you again. Take care, everyone. We'll see you soon. Good night.